Welcome everyone to Controlled Groups, confusing topic but important to benefits compliance. Thank you all so much for joining us. Our moderator for today's call is Elizabeth Allen. She will be answering the questions you send through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recordings in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to introduce our speakers for today's webinar. Joining us today are Chase Cannon, Senior Vice President and Deputy Chief Compliance Officer of Benefits Compliance at NFP, and Carol Wood, Vice President and Counsel of Benefits Compliance at NFP. We're very excited to have them speaking with us today. It is my pleasure to hand over the call to our speaker. Carol, the floor is yours.
Thank you, Amber, and good afternoon, everyone. Thank you for joining us. We're here to discuss today control groups, and we have an apropos title. It is a confusing topic, but extremely important to benefits compliance. So just starting out by saying we do recognize that it's a technical topic, but it is significant. So we hope you stay with us today and just focus on the main points. Don't get bogged down with the details. I'm Carol Wood, Vice President and Counsel, joined by Chase Cannon, Senior Vice President and Deputy Chief Compliance Officer at NFP. We're your presenters today. And just before we begin, note that this program is intended just for general guidance and informational purposes only. It's not intended as tax or legal advice. Any questions regarding the specific application of the law should always be addressed to your legal or tax counsel, and the information is current as of today. To review our agenda for today, we're going to start out by discussing control groups, just an overview and definitions. And then we'll discuss the impact of control group status on the various laws. There shall be ERISA, the ACA, Cafeteria Plan and Non-Discrimination Rules, Cobra, the Medicare secondary payer requirements. We'll also discuss some carrier considerations, FMLA. And throughout the presentation, we'll be mentioning special situations in mergers and acquisitions, because control group status does come into play there, particularly when the transaction is structured as a stock transaction. And then we'll close with some key takeaways. All right, starting out with control group overview and definitions. Well, why were the control group rules created in the first place? And the rules were designed to prevent businesses from using their structure to receive unintended benefits or avoid legal obligations. So these originated back in 1964, and the IRS established the control group rules as part of a tax reform package to assist small corporations. Large businesses tried to take advantage of lower rates for small corporations by organizing into many small businesses. Then in 1974, ERISA added certain code sections 414B and C that require employees of commonly controlled entities to be treated as employees of a single entity. And then in 1980, Congress enacted 414M, and this was, they issued proposed regulations a few years later to address employees in what are known as affiliated service groups. So why is control group status important? Well, I mean, there's outside of the benefits area, there's tax implications. The status can affect tax rates and reporting. There's also liability issues. Joint and several liability can apply to employees who are members of a control group. And in the benefits area, the determination impacts the application of laws for executive compensation, retirement plans, health and welfare plans, which of course is our focus today, and mergers and acquisitions. As I mentioned earlier, knowledge of the status, the control group status, is essential for the parties to properly structure the transaction and understand their respective obligations. What do the control group rules address? And the rules really answer who is the employer. the application of most benefit compliance laws consider employees of the quote-unquote employer. For example, the ACA employer mandate and Cobra apply only to an employer of a certain size. If an organization is comprised of multiple entities, determining that employer often requires analysis. So the code section 414, it treats two or more entities as a single employer if there is sufficient common ownership or a combination of joint ownership and common activity. And the idea of aggregating numerous entities into one employer due to common ownership applies not only to corporations, but partnerships, sole proprietorships, and other forms of business entities. What are the basic types of common ownership? Control group is the term that's broadly and perhaps too broadly used to refer to commonly owned entities. However, common ownership can take several forms. Control group of corporations is the first one, perhaps the most common, that refers to a group of commonly owned corporations. The types are parent subsidiary, brother, sister, or a combination. Then there are a term trade or businesses under common control. So this could be a mixed group of corporations, as well as partnerships, proprietorships, and other business entities. And then there's the affiliated service group, describing entities related based upon joint activity or a combination of joint activity and common ownership. That might be like a joint venture. Determining the status can be very complex, as we'll see. So in all cases, you'd want to consult with counsel and or tax professional if there are any questions. Let's look at the definitions. How is a control group of corporations defined? We said the first type is a parent subsidiary. And this is where one or more corporations are connected through stock ownership with a common parent. The parent must own 80% of the stock of at least one other corporation, and 80% of the stock of each other corporation must be owned by one or more corporations in the group. So as an example, you have parent core that owns 100% of subsidiary A, which owns 80% of subsidiary B and 90% of subsidiary C. So parent and subsidiaries A, B, and C are a control group, and therefore one employer under the code section 414B rules. So we can see in each case that the parent has 80% ownership of the subsidiary, and each of the subsidiary A has 80% ownership of the other two, or at least 80%. And one entity doesn't necessarily have to have 80% or more ownership. It could be, in this example, sub B and sub C each have 40% ownership in, let's say, sub D. So we can have some interesting configurations as long as that 80% ownership is reached. And the second type of control group is a brother-sister control group, and that's where a group of corporations in which there are 5 or fewer common owners, and these are individuals, estates, or trusts who are the owners, and that's an important distinction. They would directly or indirectly have a controlling interest, generally that's 80% or more in the stock of each corporation, and effective control, which generally requires 50% ownership of the stock of each corporation, but only to the extent stock ownership is identical with respect to such corporation. Well, that sounds like a lot of words. So let's take a look at an example here. To meet the first prong, we have a controlling interest. So we need 80% or more for these individuals to have of the stock of each corporation. Well, we reach 100 when we add up the shareholders. We have shareholder 1, 2, 3, 4, and their ownership collectively in corporations D and E is 100%. So we meet the first prong. An effective control looks at identical ownership in both corporations. So shareholder 1 has 30% ownership in D and E, and the shareholders 2, 3, and 4 each have only 10%. However, when we add that up, we surpass the total of 50% and 60. So D Corp and E Corp are members of the same control group, and they're considered one employer under Code 414. And then you can have a combination where there's 3 or more organizations forming a combined group, if each organization is a member of either a parent subsidiary or brother sister control group, and at least one organization is the common parent organization of a parent subsidiary control group and also a member of a brother sister control group. So let's say we have individual I owns 80% of corporation F and 90% of corporation G, and corporation G is the owner of subsidiary H. So the result here is that F, G, and H are a combined control group because F and G are a brother sister control group. They meet those requirements, and corporation G and subsidiary H are a parent subsidiary control group. What if the related entity is not a corporation? And I touched on this earlier. So 414C addresses the term that's used as trades or businesses under common control. I think in the industry, often we just use the same term control group that we use for corporations, but this refers to a mixed group of corporations, partnerships, proprietorships, and other entities. The same parent, subsidiary, brother, sister, and combined control group rules that apply to corporations also apply to these other types of businesses. However, ownership is determined differently for the non-corporate entities. Stock ownership may not apply, so the tests look instead at the control that an entity or individual has over another one. For example, control of a partnership may be determined based upon the capital or profits interest in the partnership. Here's another example where the related entity is not a corporation. We may have a tax-exempt organization or nonprofit. And here we'd substitute the word ownership with control and look at who has the right to elect or appoint or remove the tax-exempt organization's trustees or directors. So here common control exists between an exempt organization and another organization if at least 80% of the trustees, directors of one organization are either representatives, trustees, directors, agent, or employees of the other organization, or they directly or indirectly controlled by the other corporation. And that means that the other organization has general power to remove those trustees and directors and appoint new ones. So here's an example here. Exempt organization A has the power to appoint at least 80% of trustees of exempt organization B. Organization B is the owner of all the outstanding shares of corporation C, which is not an exempt organization. Organization A has the power to control at least 80% of directors of exempt organization D. Hence, A, B, C, and D are the same employer for the purposes of any plan maintained by A, B, C, and D. What is constructive ownership? This is sometimes also referred to as the family attribution rules. Under the control group rules, the determination of ownership can include constructive ownership, which is an interest attributed to a party other than the actual owner. So, for example, an individual's ownership in a corporation includes the interest of a spouse or a child under 21. But exclusions apply, allowing this constructive ownership to be disregarded in certain situations. So it's really a two-step process. And due to the complexities of these rules, again, a tax professional should be consulted. And I'm not going to go through, all the examples, but, there are different attribution rules that would apply to corporations, partnerships, and estates and trust. And it's just really something to be aware of, that you may have to look at ownership, other than that actual individual shareholder that you're looking at when you're determining a brother sister control group, et cetera. What is an affiliated service group? I think by far this is the most complicated. An affiliated service group is an aggregation of employers that's based upon joint activity or a combination of joint activity and common ownership. The joint activity may be services that two or more entities provide to each other or jointly to a third party. One of the entities must be a service organization whose principal business is performing services, meaning the gross income of the business consists mainly of fees, commissions, or other compensation for personal services performed by an individual, or the business is engaged in one of the following specified service fields. And this came from the proposed regulations: health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, and insurance. So for example, an attorney is incorporated and the corporation is a partner in a law firm. The attorney and his corporation are regularly associated with the law firm in performing services for third parties. So the result here is that the corporation and the law firm are an affiliated service group. They're performing together services, for clients or other third parties. And these affiliated service groups are one employer under the IRS rules. So they are for most purposes but not under all laws. And Chase will be explaining that momentarily. But particularly with affiliated service groups, this is definitely where you'd want to engage a professional. I used to work in the retirement sector, and the IRS even had a program, I think they've abandoned it, where you could actually file for a determination because it was so difficult to make that assessment sometimes. Well, thank you for hanging in for this first part. I think this is the most difficult and technical part, just going through the rules. But now we're going to move on to why these rules are really relevant, how they would apply, how these would apply to in a health and welfare plan context. And with that, I'm going to turn the presentation now over to Chase to start out by discussing how this impacts ERISA requirements.
Thanks, Carol, and thanks for walking through those rules. And if your head is spinning right now, that's okay. That's kind of how these rules go. They are head spinners. And so don't feel like you have to remember every single one of those rules that Carol just went over and that are in the slides here. Just know that there are a couple different ways that you can be a control group. And, those are some basic examples there to help understand those concepts. But this is one of the first questions we always ask our clients and prospective clients is, are you a member of a control group? And what we're really asking, obviously, there is a lot of different ways you can ask the question, but do you have related employers? Do you have connected employers? We're going to see the term aggregated employers, and they're all kind of getting back to the same idea. But starting with ERISA, because this is really the list of laws where control group status really matters. We're going to go through that starting with ERISA here. And what we're going to start with is the general rule under ERISA. Remember, ERISA is one of these primary laws here that controls for group health plan status. And the question we get most often is, can we offer one plan to the employees of multiple companies under common control? And so the example we wrote out here is the parent corporation owns at least 80% of the stock of 3 subsidiaries. The parent and subsidiaries want to offer one plan to the employees of the parent and all 3 subsidiaries. And is this permitted? And the answer here is yes, really is permitted, but there are a few things to consider. And again, this gets back to what Carol was explaining, that group of companies is going to be considered a single employer for ERISA purposes, as long as they're all under the same control group, as long as they're part of the same control group. But the answer here is yes, one plan can go to the employees of those 4 different entities, the parent and the 3 subsidiaries, if all funds under the plan are available to provide benefits to all employees. That's a fancy way of saying, make sure your benefits and the plans are actually available to all of those employees. And then the second part here is really the intent to maintain one plan is reflected in the plan document. So think of this as the formalization of that. And that means looking at the plan document that specifies the plan sponsor, which is usually would be the parent company and the participating entities. In other words, make sure that whoever is going to be covered under this plan, whichever entities or subsidiaries are going to be covered under this plan, make sure they're listed in the plan document. Along those lines, and we hear this term wrap document, that is another term for a plan document, but is specifically intended to describe a situation where you're including several different benefit components under one plan. So you'll hear that mega wrap or wrap document. That means you're including maybe a couple of medical options and dental health, dental and vision, and maybe disability, maybe life, maybe some of these other benefits. You're wrapping them all into one document, and that triggers, under the third bullet there, one Form 5500 that would be filed for that plan. And so your Form 5500 usually follows whatever's outlined in your plan document. And if you've wrapped them all together, you've kind of made one plan and therefore one Form 5500. So bottom line here, you can offer one plan to multiple entities within a control group. You just got to make sure they're actually part of the same control group by going through that analysis that Carol outlined, and then by formalizing things in the plan documents to make sure it's very clear. And then, of course, communication with employees to make sure they understand what they're eligible for. Carol mentioned that sometimes the affiliated service group rules are different here. And this is one of those notes here. An ERISA plan maintained by an affiliated service group is generally not considered a single employer plan. We don't see a lot of those, but it's definitely worth mentioning here. So the next most common question we get is, what happens if you do offer one plan and it happens to cover employees that are employed by companies that are not related or are not control group members? And this is really the big risk here, is the creation or potential creation of what we call a MIWA. MIWA is a fun acronym to say, but it's not so fun when it comes to compliance. But it stands for Multiple Employer Welfare Plan. And what is that? It is, just think of it as one plan covering the employees of two or more non-related companies, non-control group members. And so MIWA is kind of we almost think of it as a swear word in the benefits compliance world. And that's not because they're prohibited. They actually are allowed. But we think of it as a little bit of a swear word because it's a very difficult compliance road ahead once you've created a MIWA. And so listed here are a couple of the obligations that come along. And the first one is at the federal level under ERISA, MIWAs are subject to an additional filing requirement. It's Form M1, M as in Michael 1. And that is due, it's similar to Form 5500 in that it's an annual filing requirement. And it's really actually not too difficult to complete. It's really just asking whether the MIWA plan and the MIWA itself are following specific federal laws. But it comes with that additional liability that if you miss filing that, you're going to get penalized, and the penalties can be high. So that's at the federal level. But the really big issue here with MIWAs is with the state law. And this obviously varies by state. But you have to think about every single place or every single state where some employee might be located. It's not just where the plan is located. It's not just where the MIWA is located. It's not just where the employers are located. It's every state in which somebody is covered. And in other words, any location that an employee is working in. And so what's the problem with state law? Well, states are very interested, or a lot of them are, in regulating MIWAs, and states will have requirements that the MIWA be licensed or some type of registration, or that they have a minimum number of participating employers. They may have coverage mandates or reserve requirements. What's a reserve requirement? If you're self-insured, you got to have some money on hand and you've got to be able to prove that. And so it becomes this annual host of filing obligations with the state. And then if we go to self-insured MIWAs, some states prohibit those altogether. And so you have to be very careful and just know that these laws are out there. If you're in a fully insured context with the MIWA, it's much more doable because you have a carrier involved. States are generally more comfortable when there's a carrier involved. But if you're wading into that self-insured area with a MIWA, it's really, really challenging, and some states just prohibit it altogether. Where do we see this come up a lot? Sometimes this can come up where employers are unaware of their control group status and decide to go ahead and have one plan and offer it to a couple entities that they think are under common control, but it turns out they're not. And so that's the creation of what we call an inadvertent MIWA, and that can be problematic. And so that's why the control group rules are so important here. If you're covering multiple entities under one plan, make sure you take that extra step to figure out if they're under the same control group. And to do that, of course, with the MIWA, and because of all these state filing and the additional Form M1 filing, we really, really encourage outside counsel's help on that. The other area where this comes up, and we mentioned we're going to be talking M&A context throughout this webinar. This is a great point here. And this happens after mergers and acquisitions sometimes, depending on the business transaction, the ownership interests that are purchased. Sometimes after an acquisition, it's very clear that the buyer is now 100% owner of the seller. In other instances, it's not so clear. You may have a couple of buyers. You may be selling part of the business and figuring out whether the entities are still becoming part of a control group after purchase or if they stay separate. But what sometimes happens is that the buyer and the seller agree to continue, usually the seller plan, to cover employees through the transaction and maybe for some months or even up to a year afterwards to try and have consistency for benefits for those employees. The intention there is noble, right? You're trying to keep employees enrolled, covered. But what happens is that if those employees have actually become the employees of the buyer and they're covered by the seller's plan, now you have one plan that's, and the two companies, sorry, one more. The two companies are not part of the same control group post-transaction. Now you have one plan that is covering the employees of two or more non-related companies. That means it's a MIWA. And that's another time that we say inadvertent creation of a MIWA. It may not have been in the intention. It may maybe the parties weren't even aware that they created a MIWA. That doesn't matter when it comes to how the Department of Labor or the IRS might view this. They'll say, well, you created a MIWA. So parties should always consult with counsel. We say that a couple of times throughout here, but particularly in the merger and acquisition context, where there's some continuation of coverage for employees and it's not through the employer that bought or is now employing the employees. And so I know in many instances we see this happen, and we see the buyer saying, well, we're just going to continue the seller plan, or we're going to contribute to the seller plan, but these employees are still, that are now ours, are going to be covered by the seller's plan. And everybody decides that that's okay. It's worth the risk of this temporary creation of a MIWA. And so that is out there, and that is sometimes part of a merger and acquisition. We just have to highlight that and say, well, even a short temporary MIWA is still a MIWA, and there's still some risk that the Department of Labor or a state regulatory agency would come in and enforce something there. We haven't seen a whole lot of enforcement activity there, but we definitely have to raise the issue. And again, another reason to have outside counsel weigh in on it. So that's ERISA. And let's talk a little bit ACA. ACA is the Affordable Care Act, also referred to as health reform, healthcare reform, or Obamacare, depending on how you've referred to it over the years. But this gets to the idea of the ACA's employer mandate. That's the requirement to offer coverage to your full-time employees and to ensure it's affordable. We're all familiar, or hopefully familiar with this now, but it applies to larger employers, right? And we say larger means at least 50 full-time employees or full-time equivalents. And that relates to the prior calendar year. So we're looking at 2021 counts. And if we're over 50 in 2021, that means in 2022, we're complying. The determination of that ALE, that's applicable large employer. That's the term the ACA uses to say you have to comply with this employer mandate. If you, when we're looking at ALE status and looking at that 50 full-time count, we have to do that on a control group basis. So the full-time employees of all members in the control group are going to be added together, is another way of saying this. And so let's look at a quick example we have at the bottom here. A parent company had 40 full-time employees in 2021. They own 100% of a subsidiary. So the parent and the subsidiary are in a control group. The subsidiary had 20 full-time employees in 2021. The result here is the parent and the sub are an ALE. For 2022, remember we're looking at 2021 to determine 2022 status, but the combined count here, we have to look at both companies as 60, and therefore we are over our 50 full-time employee threshold. So both entities become subject to the employer mandate in 2022. So just the idea that the companies need to be looked at together. Once we figure out that the mandate applies, there's a little bit of a different kind of approach here. Really what the IRS rules say is that each member within the control group is going to be responsible for their compliance. And that means they're each responsible to make sure their own employees are offered that MEC, that's minimum essential coverage, that needs to be offered to at least 95% of the full-time employees. And remember that offer has to go not only to the employee, but their dependent children to age 26. And then if that 95% threshold isn't met, you get penalty A, which we've outlined here, which is a penalty that is applied to all full-time employees. In other words, the penalty amount times the number of full-time employees, and is triggered if you only have one employee, one full-time employee go and qualify for a premium tax credit. So penalty A is the big one, and that relates back to that 95%. Penalty B comes in if that coverage is offered by the parent and the subsidiary to at least 95%, but then it's either not of minimum value or it's unaffordable. So a little bit of review here on the penalties. Hopefully it's a review. But penalty B is only applicable per employee who actually goes and gets a premium tax credit in the exchange or the marketplace. And so we included the amounts here as a reminder for that. But let's look at a quick example, because this is really where the difference is when it comes to control groups. Let's say we had that parent and subsidiary in the same control group, and we know they each have to offer affordable coverage to their full-time employees. But let's say the subsidiary fails to do that, unfortunately, sad day. They didn't hit their 95% for 2022, and they had one full-time employee who went and qualified for a premium tax credit in the exchange or the marketplace. Here is how this works. And if you remember with penalty A, because they missed that 95%, penalty A is applied, but there is an exclusion of 30 full-time employees when it comes to penalty A. So it's basically the penalty amount times the number of full-time employees minus 30. And so in this instance, the subsidiary actually only has 20 employees. So you're thinking maybe it means the penalty isn't there, or maybe if you're going even a step further, maybe the IRS owes the subsidiary some money because it's a minus 10, that's a positive for the subsidiary. But that's not how this works. Basically, the rules say you get a proportionate share of that 30 full-time employee reduction. And so to figure that out, the subsidiary is entitled to their pro rata share of that 30 employee reduction, which actually comes out to a 10 employee reduction. How did we get there? Well, subsidiary has 20 out of the 60 employees that are part of the whole control group. And we multiply that by 30, and that will come out to 10 employees. So the takeaway here is the subsidiary has to pay that penalty. They're responsible for addressing the failure and paying that penalty. And the penalty amount is based on a pro rata reduction for that 30 employee reduction. And so hopefully that all comes out here. The actual penalty would be $27,500, which is that $2,750 penalty based on 10 employees. So here, the other part of this is the reporting. How does reporting work? And reporting is kind of the same idea. Each entity or ALE member within the control group has to worry about their own reporting. What's reporting? These are these nasty 1094 and 1095C forms. The requirements apply to each individual entity. What does that mean? Each entity actually has to file their own 1094C. Remember, 1094C is the employer level information. And actually on the 1094C, each entity here, in our example, would be the parent and the subsidiary, would file separate 1094Cs listing themselves as the employer and then listing the other in the related or aggregated control group member part of the form. And so once they do that, then they would include 1095Cs for each of their respective employees. And so the subsidiary would have 20 1095Cs attached, while the parent would have 40, representative of the number of full-time employees they each have. The failure here could result in each entity being subject to a potential penalty of $280 per failure. And then we double that because remember, there's two requirements here. You have to file the 1095C with the IRS, and you have to distribute a copy to each full-time employee. And so each of those is considered a separate failure, which is how we get that $560 per employee. So the bigger takeaway here is really, and think about too, the subsidiary and the parent probably have some P&L flow between them, right? So sometimes we'll say, well, the subsidiary is responsible for paying, and if they fail, they're responsible for handling it, but it may flow through to the parent, which is true. What we're saying is that the IRS is going to look to each of these entities directly rather than to one particular within the group. So that's the takeaway here. Let's talk about mergers and acquisitions in this context. We have an example here, but again, this is what would happen in a stock transaction where an ALE acquires a non-ALE. So in other words, a bigger company eats up a smaller one. How does that work? When does the ACA compliance kick in? And we think it's actually right as of the transaction date. There's no specific guidance on this, but this is where our conclusion has come out, and we've worked with a lot of different industry leaders on this. So our example is a chocolate shop owned by myself with 200 full-time employees. We acquire all of the ownership of Carol's Coffee. Carol loves her coffee. This is a very appropriate example here. I love my chocolate. On August 31st of 2022. We keep separate EINs and corporate structures, but we are part of the same control group. Carol's Coffee Company, remember they're 40 employees now, but now they're going to be part of a group that's 240 when we combine. They become part of our control group as of August 31st, 2022, and at that point are subject to the employer mandate. If Carol's Coffee Company fails to offer coverage to at least 95% of its full-time employees in any month after that, then they could be subject to penalty A. And then if they do offer coverage to 95%, but it's unaffordable or not of minimum value, then penalty B is in play for any month thereafter. And then both of us are going to have to file forms 1094 and 1095C when we get into 2023 reporting on the prior year's obligations. So the difference here would be with an asset sale, where if this is an asset sale, then Carol's employees would become part of my company, but they would become part of them as new employees. And in an asset sale, you have a termination of employment and then a new hire status when they come. So then it would just be my company reporting on these new employees that are part of my company. I would add them to my 1095C count. But this is the more common question we get. Stock transactions generally more common. And so we wanted to address, really it's immediately upon stock transaction that obligation to offer coverage kicks in. Let's look quickly at cafeteria plan and non-discrimination rules. And these are two separate topics, but they kind of go together. The first question is really related to whether you could have one plan, one section 125 plan or cafeteria plan for the employees of different companies within the control group. This is very similar to the ERISA plan document scenario we talked about earlier. Can you have one plan for multiple companies' employees? The answer here is yes. You can have one plan as long as everybody's in the same control group. And on the other hand, you actually can set up separate Section 125 plans for each of the companies. Here we have four companies. Chase's Cuisine Corp. and is the parent company owning 3 subsidiaries 100%. That's Best Bagels, Patrick's Pizza, and Sarah's Seafood. The Cuisine Corp. Has a cafeteria plan that covers its employees and the employees of the bagel and pizza companies. However, Sarah's Seafood, Sarah's a bit of a renegade and wants to sponsor a separate cafeteria plan for its own employees. And the result here is this is totally allowed, but each plan would need to specify who is eligible for that plan and they would have to satisfy the applicable non-discrimination rules. What are those? What are the non-discrimination rules? No, these are always onerous and annoying, but the basic idea here is that the Section 125, and we're going to throw in Section 105, which applies to self-insured plans. These are both designed to prevent discrimination in favor of your highly compensated employees or your key employees. We're going to stick with HCE as our acronym to describe both of those. Highly compensated employees, or HCEs. And the takeaway here is that you have to include all of the employees within the control group when you're figuring out who is an HCE and whether you can vary benefits among the different companies. You know, that same question, can we offer, in our prior example, can we offer that one Section 125 plan or even a different medical plan to Sarah's Seafood Company? And the answer is yes, you can do that as long as it's based on a business, what we call bona fide business classification, which just means there's a solid business reason for doing that. But you got to figure out if the result of that somehow favors highly compensated. On the next slide, we look closely at the definition of HCE. And this is getting a little technical, but there is a slight difference when you're running the tests. And you're going to have to run tests under both of these if you have a self-insured plan to include Section 105. The Section 125 basically includes any officer, a more than 5% shareholder, or any individual with 130,000 or more in compensation. Whereas Section 105 has a top 5 paid officer and a more than 10% shareholder, which are both a little bit more restrictive. But then you have this bucket that catches everybody in the top 25% of all employees with respect to compensation. So you are always going to have an HCE under 105, whereas under 125, you might not, depending on the officer structure and the salary level. So looking at a really quick example, and this example is meant to show that you have to include both companies. We're going back to our parent and subsidiary 2-entity scenario. But looking at the number of employees under the parent company here, you have 25 management at 145,000, 25 management employees at 135,000, and then 50 line workers that are making 85,000. And then under the subsidiary, you just have 100 line workers. Think of that as your rank and file at 70,000. And so really what we're trying to show here is under Section 125, remember that HCE definition includes anyone who earns more than 130,000. And so a result there is that we're looking at just the straight dollar amount. And that's anybody over that 130,000. So that would include 50% of the parents' employees there, all the management employees. Under Section 105, and this is really the distinction we're trying to make here, some people would say you just look at the control group, or some people would be inclined to say you just look at one company, the parent company, when you're figuring out who is in the top 25%. And if you did that, your result would be that only 25% of the parent company's employees, their management employees, would be HCEs. But the reality is, and the rules say that you have to look at all employees of both the parent and the subsidiary. And when you do that, you'll see instead of only having 100 total employees, you have 200 total employees. That means that actually 50% of the parent company employees are HCEs, because you have to look at the top 25% across both companies. And so that's just a quick example. You don't have to remember these numbers or anything. It's just a quick example to show that the difference when you include everybody within the control group when you're running the test. The last part here is really a quick slide to show why that matters. Under these non-discrimination tests, you really have two components that are basic. It does get a little bit more complicated, but if you're trying to keep it concise, eligibility and benefits are really the two tests. And the eligibility test really has three subtests that you can pass. And two of them, the 70% and 70%, 80% tests, those are just looking at who is eligible and whether enough of the total population is enrolled. And so, but the third one there is really when you start varying benefits. And this is where it gets a lot more complicated, but that's based on the mix of highly compensated employees versus non-highly compensated employees, and whether they can pass that test. And so again, we don't want to get too far into this, and we only have a few minutes here, but just know that it makes a big difference when you run these non-discrimination tests, that you do have to include employees across all companies in figuring out who is the HCE group. The last slide here for non-discrimination is a question we get often. Hey, we just bought a new company and we want to keep the benefits separate for maybe a year until we can merge everybody onto the same plan. And again, that's a little bit, if you're part of the same control group, it's fine to have different plans for different segments of employees. But the non-discrimination testing, some people want to ignore that through some type of grace period. I think or hope that the IRS would have a grace period there. And actually on the retirement side, there is a little bit of a grace period, but on the health side, we don't have that same guidance. And so again, if there is a little bit of risk there, we haven't seen high enforcement on this. If there's, you buy a new company and it has a bunch of highly compensated employees and they have a sweet plan, right? But you're trying to merge them all together onto the same plan within a year or so. You just need to be aware that there's this non-discrimination risk that one plan is going to be favoring highly compensated. So this is another thing to work closely with outside counsel on. Hopefully your M&A attorneys would be able to help with that. But let's move on to Cobra obligations. This is another big question, and Carol's going to jump back in to talk a little bit about these.
Great. Thank you, Chase. That was a lot of information to absorb, but valuable. I guess I'm moving on to Cobra obligations, and this really impacts your smaller employers. We know, of course, that most group health plans are subject to Cobra. However, there is a small employer exception, and a group health plan is not subject to Cobra for any calendar year if all employers maintaining such plan normally employed fewer than 20 employees on a typical business day during the preceding calendar year. And for purposes of determining whether an employer has 20 more employees, all employees of all related employers under common control must be counted. So as an example, we have parent corporation owns 100% of the stock of its subsidiary S corporation on a typical business day in 2021. P corporation employed 18 employees and S corporation employed 12 employees. And the result here is that any group health plan sponsored by P corporation or S corporation is subject to Cobra in 2022 because P and S are members of the same control group under the IRS rules, and their total employee count was 30. It was greater than 20 in 2021. This is a question in the merger and acquisition context. If one small employer with less than 20 employees acquires another small employer, when does the Cobra obligation begin? And we just discussed the general rule, and the answer really varies here between a stock transaction and an asset purchase. Because again, with a stock transaction, there's a purchase of ownership, and that's when there's often a change in the control group. So with a stock transaction, employees of both entities in the prior year must be counted for purposes of the exception. That's because the acquisition will result in the two entities becoming part of the same control group. Let's look at an example. Company A will merge into Company M on July 1st of this year. Each company had 12 employees in 2021. The result here is that the surviving company M is subject to Cobra as of July 1st of 2022 because the combined employee total in 2021 was 24, so that was 20 or more. By contrast, with an asset purchase, the parties don't become related entities as a result of the transaction, so their employees in the prior year do not need to be counted together. You have Company A purchasing Company B on March 1st of this year. He hires 10 Company B employees. In 2021, Company A had 15 employees, Company B had 10 employees. The result here is that Company A's plan would continue to be exempt from Cobra in 2022, but Cobra would apply as of January 1st of 2023 because Company A employed 25 employees, that is 20 or more, on at least 50% of its typical business days in 2022. And then moving on to Medicare secondary payer requirements. And just to review here, the MSP rules, as we call them, require a plan to offer the same benefits to those age 65 and older as younger employees. And employers can't force or incentivize employees to enroll in Medicare. And the rules also govern the coordination of benefits and whether the plan or Medicare pays primary. But MSP rules, these are the rules based on age, it's a little different for disability, only apply to group health plans of employers with 20 or more employees for each working day in at least 20 weeks in either the current or the preceding calendar year. And the point is that for this purpose, the count includes full-time and part-time employees of the employer and, if applicable, members of the employer's control group. Now, this is under Code Section 52, it's a little different, or the affiliated service group rules that we discussed under Code 414. So, do MSP rules consider control group status? We said yes, but the control group definition differs. So we had said that under the Code 414 rules, that for a parent's subsidiary, a parent must have at least 80% interest in a subsidiary to form a parent subsidiary control group. And a brother sister control group requires the owners to have an 80% controlling interest in each corporation. And that's in addition to the effective control requirement. But for Section 52 purposes, the 80% threshold is actually reduced to 50%. So as a result, more related entities will be a control group under Code Section 52 than under Code Section 414, and that's potentially subject to the MSP requirements. So in some cases, a separate analysis may be required just for this purpose. And then, Chase, I'm going to turn it back to you to discuss carrier considerations and close out our final segment.
Yeah, thanks everybody for hanging on. I know this is super technical and can be a little bit overwhelming. But hopefully you're picking up little nuggets here and there. And of course, we'll have the slides to you to help go back with any questions. One thing to consider here that's big is the carrier side of this and figuring out and making sure that you are representing and putting on an application accurate information when a carrier asks you about control group status. A couple of reasons this matters. It's really about group size when it comes to state insurance rules, making sure that if you say you're a small company and you're getting these policy ratings or minimum participation requirements or other restrictions on rating, that depends on whether you're a small or a large group. And we've seen situations where a small organization was actually related to a larger one, yet put this on the carrier form that they were small and ended up causing some problems. So knowing your control group status is helpful when working with the carrier, primarily for determining the correct group size, small versus large. That's, again, 50 in most states, but 100 in a few when we're talking about the number of employees of small versus large. And again, the other big part here is the information that's in the carrier contract or the carrier application needs to be accurate so that the carrier doesn't come back later and say, hey, actually, you didn't tell me that you were covering the employees of a certain related entity. And in some instances, we've seen carriers come back on a large claim and say, we did not know you were covering this affiliated group or this related group. And so we're going to deny the claims there. And so the idea of the contract indicating which members or which subsidiaries or affiliates, however you want to call those, which one of those will be covered by the policy, and then accurate information in the group size and the number. And so just working closely, that also applies in the self-insured context for the stop loss carrier, another reason that you might want to review control group status. And then if there's any change, if you acquire somebody during the year or you sell off a part of your business, that could also impact the carrier contract or the carrier policy. And so just being always in whatever situation you're in, making sure that the carrier or the stop loss carrier knows what's happening and knows which entities are being covered, which employees are being covered, what are the eligibility terms. This is just hugely important to avoid problems down the road. And then a last note on Fmla administration, because this is another area where the rules very different, they're a little bit different. We've been kind of focusing on the IRS 414 rules. For Fmla administration, that is just one of the factors that come into play. But FMLA uses this additional, what they call integrated employer test or joint employer test. And it really looks more at if you have different establishments or divisions, you have to count all the employees at those different establishments or divisions if there's common management and whether those companies are, or those different locations are integrated. And the 4 bullets in the middle of the slide here really get to that, whether there's common management, whether there's interrelation between operations, centralized control of labor relations, and then it gets to this degree of common ownership or financial control. And so if you kind of have all 4 of those as common, in other words, let's say our Austin location where we are here in Texas is really controlling our Oklahoma location based on those 4 factors. If we looked at them, now we have to combine the companies when we're looking at whether FMLA applies. Remember, FMLA applies if there's 50 or more employees in 20 or more work weeks in the current or preceding calendar year. So don't have to remember all those details, but just know that the FMLA analysis when it comes to common ownership is a little bit different and pulls in this integrated employer test. There's a great publication out there, the DOL's Employer Guide to the FMLA. And if you pull that up, you can just Google it. And you'll see in that publication, there's some really good examples of how to go through this analysis. But it is another one that you want to make sure that you are doing correctly, and that might take outside counsel's assistance to run through that analysis. Okay, so we're at the very end. Our key takeaways here on this last slide are really the things we want you to remember. And again, thanks for sticking with us. This is a really difficult, challenging area of compliance and of the law. I can say I spent a couple extra years doing a tax degree, a master's in tax law, and had a class specifically on this, and I still can't right all the time. It's just so complicated. So don't feel bad at being overwhelmed. Just focus on the high points here. Know that the control group status impacts the application of many laws. Ask questions within your organization. If you're an HR professional or benefits professional, you're not expected to know all the tax rules and know these questions. But there are people within the organization that should know, whether that is the owners, whether it's the C-suite, whether it's the accounting department, all of these, somebody should know. And it's really a threshold issue, and it has a big difference on laws outside of the benefits world, which is why more people within the organization should know, or someone should know. If there are questions, go to a tax professional or a tax counsel to get the correct determination. And then be careful. We talked a little bit about inadvertent creation of a MIWA. If you are offering one plan and it's covering multiple divisions, make sure that those divisions or EINs or whatever they are under your control group, and then run through this list of ERISA, ACA, non-discrimination, Medicare secondary payer, and all of these, and make sure that you are aware of the rules. And then if there's a merger or acquisition coming up, talk to the people involved, talk to the attorneys involved, and figure out how that change in ownership is going to impact things. If you have a new company becoming aboard, ask the question, will they be a wholly owned subsidiary? Are we going to be part of the control group post-transaction? Because if they're not, it's just going to be a big discussion about how to handle benefits for them. And if they are, you want to be very clear so that you employees. So that's pretty much it. Thanks again for hanging on. And I don't think we saw very many questions, and I know we're over our 1 hour time. So I really appreciate everybody joining. Please let us know if you have any questions. And with that, we'll flip it back over to you, Amber. And thanks, Carol.
Thank you, Chase and Carol, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We will be sharing the recordings in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you everyone for joining us, and have a great day.